Coming up on Market to Market, the president threatens to slap tariffs on a major trading partner. High water and tornadoes sweep across the country.
Just little by little, so...
And market analysis with Dan Huber next.
Pioneer Hybrid International is a proud sponsor of Market to Market. Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. This is the Friday, May 31 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Delaney Howell. Thursday evening, the president took his well-worn tariff hammer and used it on the nation's number 3 trading partner. Just days after dropping steel and aluminum tariffs and hours after Congress received the USMCA, the president threatened Mexico with duties on all imported goods. Mexico's president has vowed to not fall for any provocation and says the use of coercive measures does not lead to anything good. Peter Tubbs reports.
The president took a different approach on immigration, this time slapping a 5% tariff on Mexican imports, with more threatened. The surprise news came just hours after Mexico's trading leaders pledged to move forward on passage of the USMCA, a major campaign promise of Donald Trump's. The White House is looking to slow the flow of undocumented immigrants into the United States. On June 10th, the United States will impose a 5% tariff on all goods coming into our country from Mexico, until such time as illegal migrants coming through Mexico and into our country stop. Iowa's senior senator doesn't see a connection between the two storylines. Trade policy and border security are separate issues. This is a misuse of presidential tariff authority and counter to congressional intent. Mexico is the country's top consumer of corn exports. No word yet on retaliation by Mexico. Economists were quick to point out that tariff costs are broad and shared.
The tariffs would impact our consumers and their producers. But the idea is that they're likely to retaliate, oftentimes with tariffs themselves, and that means it's hitting their consumers and our producers. So in the end, everybody shares a little bit of the cost of a trade war.
And the idea is of course, to incentivize the Mexican government to cease or slow down immigration. It's not going to happen. It's not going to work.
The White House defended the plan, saying the tariff move was expected.
The president didn't blindside his own party. If Republicans weren't aware, then they haven't been paying attention. I don't mean that in a bad way, but the president's been talking about, we notified a number of members of Congress prior to the statement yesterday, but at the same time, anybody in this country or frankly in the world that says that they're surprised by this has been living under a rock and not paying attention.
For Market to Market, I'm Peter Tubbs.
The EPA approved E15 for year-round use this week. It is yet to be seen what kind of impact this will have on prices. Pennies matter, whether it's on a bushel of corn or the price on a gallon of gasoline. Consumer spending slowed last month, rising only 0.3%. Despite the decline, the inflation rate moved 1.5% higher, and consumer confidence moved higher on positive feelings about jobs, wages, and business conditions. Currently, 83 domestic U.S. river gauges are reporting major flooding. Some of those same areas had to deal with severe weather as tornadoes touched down from Idaho to Pennsylvania. Paul Yeager reports.
During 4 30-day stretches in 2003, 4, 8, and 11, reports of tornadoes topped 500. In 2019, is likely to be added to the list. Including this week, there have been 13 straight days of at least 8 tornadoes a day. The National Weather Service told Kansas broadcasters to use the strongest language possible to warn people of approaching storms. The storm system proceeded to drop tornadoes on the Kansas City metro area and just west near Lawrence. Rain was the other big story of the week. Corn and soybean planting remained at historically slow levels as storm after storm kept tractors waiting to re-enter the fields. Several U.S. rivers are making life difficult for those near already swollen bodies of water that, in some cases, are reaching near record levels. The Arkansas River is expected to pass a mark set in 1990. In Fort Smith, this neighborhood was only accessible by boat. The river in the border town with Oklahoma is twice the level it was just 10 days ago.
Exactly right.
In the state of Mississippi, scenes like this have played out for the last 4 months. The epic flooding of today in the Delta rivals the great floods of 1973 and 1927.
This year I have planned on planting corn, and I did not get a chance to do so because the water started rising back in February, and we did not get an opportunity. I got the land ready, but I didn't get a chance to get it planted before the water started rising back in February.
For Market to Market, I'm Paul Yeager.
In the 3 decades since the Conservation Reserve Program began, millions of environmentally sensitive acres have been kept out of production. While the program has done wonders for preserving the land and increasing habitat for endangered species, there have been some unintended consequences. Colleen Bradford-Krantz has more in our cover story.
Missouri cattle producer Casey Nichols looks across the nearby fields his grandparents and parents once farmed. In every direction, the land that once bustled with farm activity is now enrolled in the federal government's Conservation Reserve Program.
Our home is completely surrounded, 5 acres completely surrounded by CRP. And I mean in all 4 directions. And some directions for 3 miles.
While he appreciates how the CRP program has helped protect the Harrison County hillsides with soil types that easily wash away, he dislikes how the economic activity typically stirred up by production agriculture is disappearing in his immediate area.
Our township, it's around 23,000 acres, give or take. And I did some rough figuring on the amount of CRP in our township, and it's around 8,100 acres. We are the second poorest township in Harrison County. The only township poorer than us has the most CRP.
Nichols sees how older farmers, some no longer wanting to be out working every day, are holding on to the land longer than they would have in earlier generations.
If it wasn't in CRP, they would probably move on to something else. They would either rent it out to someone to farm or pasture or hay.
About a mile down the road is one of the CRP plots owned by semi-retired grain and cattle producer Gerald Parker. The field was enrolled in CRP when Parker purchased it. He later re-enrolled, not being able to justify either the cost of adding terraces for row crops or fences for cattle. The voluntary federal support package, introduced in the 1985 Farm Bill, was designed to boost commodity prices and protect the environment.
It paid for itself, and I didn't put anything down into it, and so I just got my money back, and it's been very profitable.
500 of Parker's 2,500 acres are in the program. As he's moved toward retirement, Parker began to see his CRP ground as a nice retirement nest egg, but not necessarily as the best option for supporting a rural community's economy.
Well, CRP is a good idea, but there's a lot of downside to CRP, and it reduces our income that is made from farming. It reduces our labor force needed to farm, and so it's cut down our income made off the land.
He also acknowledges how holding on to the CRP land may keep younger farmers out. To compensate, Parker has made a point of partnering with younger farmers in his crop and cattle production rather than selling or renting.
So once you get 10 years of CRP, all your ability to handle the cattle or the row crop or whatever you're going to do has been antiquated. It's hard for a young person to get started.
Farm Service Agency's Harrison County Executive Director, Brett Gilland, points out that the CRP program has a maximum allowed enrollment of 25% of a county's farmland to prevent too much dependence on the federal payments. Harrison County has more acres, 63,600, enrolled in the CRP program than any other Missouri county, but remains below that threshold at 19%.
We've got some really good, really high productive soils. We've got some land that isn't that productive that has been farmed, but it's also, susceptible to erosion. That's the kind of land that, is usually a pretty good candidate for CRP enrollment.
Gillen said the payments made to the county's more than 1,500 contract holders, most local, but about 18% living more than an hour away, amount to about $8.6 million annually. The future outlook may shift with some changes included in the 2018 Farm Bill. The cap on CRP acres nationwide will be gradually increased to 27 million acres by 2023 from the previous 24 million. The FSA will accept applications beginning June 3rd for re-enrollment of expiring CRP contracts. The only new applications being accepted this summer will be for continuous CRP, which is typically smaller but more sensitive areas, like those along rivers or other waterways. Sign up for general CRP, typically larger fields, will be opened in December. Previously, landowners received 100% of the county's land rental rate for both categories. That will change.
For general CRP, the rate is going to be based on 85% of the rental rate in the county. And for continuous CRP, it'll be based on 90% of the rental rate in the county.
Gillen says commodity prices are typically the biggest factor in shifting CRP enrollment. The typical 10 to 15-year contracts don't allow farmers to make year-to-year enrollment changes without refunding the government's payments plus interest. While Parker is disappointed that he will receive a lower percentage on land in the program in the future, he does hope the changes will discourage out-of-state landowners from buying land just for the government payments. Some producers with expiring contracts may now be eligible for 2 additional annual rental payments if the land is sold or rented to a beginning or socially disadvantaged producer. Nichols hopes this inspires retiring farmers to exit the program and begin handing off to younger producers, perhaps filling the surrounding pastures with livestock again.
I can't think of any young farmer that wouldn't want to come out here and buy a farm and just sit there and look at it. They don't want to say, well, 6 more years when my contract's up, I want to participate. They want to be on it. They want their hands in it. They want to do things with it.
For Market to Market, I'm Colleen Bradford Krantz.
Next, the Market to Market report.
Threats of a Mexican trade war failed to pull out the massive weather gains in the market. For the week, July wheat gained 14 cents while the nearby corn contract shot 23 cents higher. The soy complex was bolstered by poor planting weather. The July soybean contract skyrocketed 48 cents. July meal tagged along, moving up 20.80 per ton. July cotton shrank 31 cents per hundredweight. Over in the dairy parlor, June Class 3 milk futures fell a dime. The livestock market felt pressure from higher grain prices. August cattle lost $4.87. August feeders shed $10.10, and the July lean hog contract cut $2.02. In the currency markets, the U.S. dollar index improved 25 ticks. July crude oil declined $5.21 per barrel. COMEX gold bumped up $21.10 per ounce, and the Goldman Sachs commodity index plunged nearly 20 points to finish at 406.30. Joining us now to offer insight on these and other trends is one of our regular market analysts, Dan Huber. Dan, welcome back.
Thank you very much. Great to be here.
Well, we certainly had a pretty strong week up until Friday in the grains markets.
Right.
Let's talk here about what happened in the wheat markets this week. We put in the highest levels since mid-February, I believe.
Correct.
And pulled back on Friday. So, Dan, what does that set our new resistance level at, and can we break through that?
Well, realistically, if you look on at least on the chart pattern here, what we pushed back up against was what used to be support, unfortunately. I mean, we've, of course, have been taken apart here over the last couple of months. But nevertheless, this is a good sign, a good start. I mean, it is certainly being tagged along with the corn market, but in itself, I think some growing concerns about what this wet weather is doing to the wheat production out there. And then a second element that the Australian Weather Bureau had put out some forecasts that the next 3 months look quite dry in that nation. So here it could be another year of tough production down there. So I think on a longer term stance, yes, we probably turned the corner. We finally have some better prices ahead for wheat. Short term, it might be difficult to really extend the rally much more than we did here this past week, barring a real explosion in the corn market. And I guess that's the major caveat for everybody at this point in time. So.
That it is, and we've got to talk about that. I think a nice question here to set up that, will the corn market explosion continue or happen? We've got Nick in Lynn Grove, Iowa, sent in a great question. He said, how aggressive should one get on new crop corn? Where does Dan project best case corn planted acres and corn carryout for the 1920 marketing year?
Certainly. Of course, I mean, we're really trying to determine those acres here at this point in time, and really that's a large function of the market right now, is trying to give people the economic incentive to plant corn later than you would on any normal given year. And of course, in some cases, that just physically will not be possible out there. I really tend to believe right now that through either acreage shifting over to soybeans or going to the prevented plant route with crop insurance, we're probably going to lose at least 5 million acres of corn. So is
that a conservative estimate for you?
I would tend to think conservative. I mean, I've heard people talking about 15 million acres of corn, which is possible. And even as of last week, when you looked at the nation as a whole, we had 39 million acres to plant yet. Now, granted, I'm sure there was some progress made this week. Would be interesting to see next week just how much did get put in. I would tend to think conservative. If that is correct, and I think you have to keep in mind as well that we'll probably see a little larger takeaway from the percentage harvested. Normal years were 92% harvested acres versus planted. You could probably drop that down to 90% or under. So, but let's say if we are in that 87.5 million acre. Every bushel you start reducing then from trend line, which the USDA now has at 176, you're going to peel close to 100 million bushels out of carryout. So it doesn't, we're starting with a potential of 2.3 billion. It doesn't take much of a yield hit, 4 or 5 bushels, and we're down to areas where, again, we're talking about, not necessarily a panic situation in the carryout and corn, but $1.5 billion corn is certainly not $4 corn anymore, and that's probably $4.50 to $5 range. So.
Okay. So that sounds like maybe some upside potential there.
Oh, certainly. And again, like I said, the next 2 weeks are just absolutely critical. What we tend to get planted. One of the real challenges, of course, this year too, is we're really not going to have great answers on this probably until October. Yes, there'll be some good estimates out there. I mean, with the satellite technology today, we're going to have a pretty good handle on what did not get planted. But really, for the USDA to come out with official numbers, we're months ahead before we actually see that come into print.
So, Dan, with all that being said, we've got the weather, we've got potential yield drag. We could see maybe harvest rallies, which doesn't typically happen. Do you think more producers are going to turn this year then to selling corn straight off the bins or straight off the combine?
Oh, certainly there's been a lot of resistance to sell for some good reasons as well. I mean, if you don't know if you're going to get a crop planted, it makes it that much more difficult. We are certainly encouraging producers to, if they haven't looked at options before, develop some option strategies. Lock a floor in if you think leave the upside open. Certainly there's a lot of good reason to do that, but by no means, let yourself hang out there thinking that it has to go higher, because there are certainly a lot of other elements at play. The strong dollar, number one, that continues to battle us on the international front. Trade war, of course, that's not really a corn picture per se, but it certainly has an impact on the commodity sector as a whole. So, the weather markets tend to be generally short-lived. I mean, they're one-off events. When they happen, I mean, this one's unusual. Don't take me wrong. I mean, it's, I've been in this business for over 40 years, and I've never seen this kind of a wet spring. When you get a summer drought, it's over, and you might get just enough rain. You're still going to pull some yields out. If we don't get the acres planted, there's no coming back at that point. So it is a little bit different. But that said, good business management says if you're looking at what looks like a return on investment, use a strategy to try to take advantage of that.
Definitely. Well, let's talk about the soybean market.
Certainly.
We definitely know that the weather market has been driving the corn markets. Has weather been a problem yet for the soybean markets with the later planting dates, the new varieties or the shorter season varieties?
Sure. Yeah. You know, you have to say yes and no. Is it a critical problem? Not at this point in time. You know, certainly if it really continued on and this weather situation never improved, yeah, it could be a counterproductive for bean production. You know, right now I think the rally itself is almost counterintuitive. I mean, realistically, yes, we're going to see more beans. More acreage come away from corn and back into the bean market. Yes, it's early enough in the year that we can still look at some fairly substantial bean yields. And you know, when I look at the bean market trading back plus $9 in the new crop beans, you know, it's really looking at a gift horse. So I think you really, as a producer, particularly if you're thinking you need to switch acres, you need to take advantage of that and get some beans priced.
Well, and how much more upside potential do we have here? I mean, we pulled back Friday. We've got this new announcement with both Mexican tariffs and now China's retaliated as well.
Sure.
And we have a really large U.S. and global ending stock. How much more? I mean, is there really that much upside potential for soybeans?
Personally, I think it's rather limited. Like I say, we had maybe potential to take Novi beans. I mean, if we were really fortunate, we could coattail up with corn on some additional rallying corn, maybe get it back towards that 950 area. But boy, it's difficult to come up with a scenario on soybeans that you would actually call bullish, because it's, you know, not only domestic supplies that are pushing 1 billion bushels. You know, you have South American supplies that are at record numbers on a combined basis, and you have to look at the threat that you know, you have South American countries that are developing stronger and stronger alliances with China, especially, and they're going to do all they can to push production higher again this year as well. So.
It's definitely going to be a wait and see game, but we have to address the feeder cattle market. Dan, we've got some young cattlemen watching us tape the Market to Market episode today. So tell me what's going on there. We had 2 limit down days on Friday. We used the expanded limit even in the feeder cattle. We haven't seen that in quite some time.
Right. You know, and of course, I mean, the you know, live market, of course, has been in a free-for-all really for the last 30, 45 days. You know, I think a lot of that's just kind of playing catch-up. You know, we had a great price over the winter months with the, but I mean, all related to the poor weather and really pretty substantial demand. But of course, you know, once you took that market down, you know, it just really started eliminating that demand for the feeders. Initially, when the fats broke, feeders looked like they could start turning higher, but I really think, you know, one, concerns about the economy, not really seeing the kind of pickup in demand nor the pickup in export demand. And I think there was a lot of hope when we saw the Japan open the doors to U.S. cattle again. We see some business come up there. Psychologically, that hasn't happened. I think has disappointed the market. And now this rally in the grains, I think, was that last nail in the coffin that really pushed the feeders to the downside. And yes, we're probably reaching the end of the rope where we've gone to the extremes, but certainly it's going to take some time to rebuild the demand in there once again.
And not only that, I mean, from a domestic standpoint, grilling season really hasn't had a chance.
Hasn't even begun.
Yeah.
I mean, it's talk about a delayed everything this year. I mean, it's the summer months have not been for anybody out there. So.
And when you look at transitioning into the hog markets, we haven't really seen the pickup in exports that we were expecting. We're not really seeing a strong grilling season yet. Is that what's playing into the hog markets right now?
Oh, certainly. You know, and I guess I'm a little surprised. The hogs have, I mean, really, you look at the last 2 weeks, we've seen fairly substantial purchases by China. And I really thought that would kind of breathe a little bit of life back in there, but so far has not. You know, of course, weighing against that is certainly we're looking at 3 to 4% more hogs on production this year in the U.S. You know, a fair amount of competition from other countries where it is there, but I still can't help but believe that the latter half of the year, particularly from the export scene, is going to play out pretty favorably to the hog market.
With that being said, Dan, the latter half of the year, what can we expect for prices in some of the deferred months to come as we near those?
Deferred?
In the lean hog market.
Well, you know, here again, too, when you look at the prices we did push up to, you know, before we took this recent correction here, I mean, those are fairly, you know, some of the highest prices we've seen in 4 or 5 years. You know, I would think we have an opportunity to at least go back and revisit those levels. You know, I mean, if you would have asked me 30 days ago, I would have said this could have been kind of hog's ethanol moment because we just, you know, when you have a nation that potentially is losing 80 million, 100 million head of hogs.
Especially the number one producer and
of
consumer.
hog, in both cases. And really, you know, this problem, of course, has not ended there. And I think I read just this morning that now we have cases detected in North Korea. Not that they're a large hog producer, but you know, this is not going to go away for some time. So I think that's really going to shift that trade around to where, again, I think that's are we going to go back to the levels we were 2014? I don't know if I want to go quite that far yet, but I think the potential certainly exists.
All right,
So.
Dan Huber, thank you so much.
My pleasure, thank you.
That wraps up the broadcast portion of Market to Market, but we will keep this conversation going on Market Plus, where we'll answer more of your questions. You can find it on our website at markettomarket.org. Twitter remains a great way to get a good thought out in a few words. For us, 280 characters allows sharing of links to our stories and photos. You can also leave us a question for the Analyst of the Week. Give us a follow at Market to Market. Join us again next week when we'll explore how a diverse set of Western stakeholders are seeking common ground on public lands. So until then, thanks for watching. I'm Delaney Howell. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Pioneer Hybrid International is a proud sponsor of Market to Market. Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.